Yeah. Now I'm coming back to the balance sheet statement. Right. So this is banks, banks. Going to this is the side, and then this one is liabilities, right? And this is okay. Again, coming back to this neraca, right? So from the liabilities, we can divide it into like previous session, right? The current one and then the long-term one. But now we can divide this to savings, right? This is very short term. So saving is the short term of fund, right? If you are talk about time deposit, then time deposit. Yeah. And then there is a product that we call deposit on call. Yeah. On call. Right? So we put deposit, and then anytime you can call it for minimum at least 24 hours. And then if you want to roll over, you can have deposit on call up to 180 days. Right? So in this side, sorry.
Are they all short term?
Most of the liabilities of banks is short term, right? And then on the asset side, this is practically distributing loans, right? So if say this is a household loan, you know credit card, right? Yeah, this is from short term to short term, right? Savings products to credit card. So this is at household level, okay? And then at household level, if say we need house, yeah, or mortgage, yeah, then bank also provide from liability side to asset side, yeah, short-term assets to longer-term assets. So this is the keyword of bank business, transforming short-term liabilities to longer-term loan. Right? So there is always a risk that the bank cannot match the risk of transforming these short-term liabilities to long-term asset. And then commercial, of course, right? The companies, yeah. So if we have like current liabilities, then most likely these commercials or company loan short-term liabilities from banks. So from short-term to short-term, right? We are talking about current liabilities of commercials is funded by liabilities from banks, right? And then say if a company wants to buy long-term asset, right, then bank can provide loan for companies to buy long-term assets, or we can this is like fixed, yeah, asset. So again, transformation from short-term liabilities to long-term loan. Okay. And then now, do you think that bank can also provide government with loan? How can bank do that? Loan to government.
Bonds.
Yeah.
Bonds.
Bonds. So how does it work?
The government issued bonds
Okay.
and the bank take it in exchange for money.
So this is government, right? Government issued bonds, and then
And yeah, the bank,
the bank buy the bonds.
buy the bonds.
Yeah. So buy government bonds, right? Asset or liabilities? If bank buys government bonds, hmm, does bank get interest income or interest expense? So I'm calling. If a bank buys government bond, the bank get interest income or interest expense.
Income, right?
Income, yeah. So interest income, so it's on asset side, right? Okay. So this is the way commercial banks operates. The idea is to provide funds to the deficit units, right? Okay. Yeah. And then now assume that there is no bank in our financial system. Yeah? Assume. Then you have, say, all of you have money. Yeah. Come from supplier, right? Supplier. And then there are firms, from one up to firm X. I don't know, so many firms, right? So this is deficit unit. Deficit unit. So there are no bank in our financial system. Then what are you going to do if you want to invest your money?
No bank.
No bank. So you have money, and then there are many firms as a deficit unit. What are you going to do to invest your money? Sorry? Go to exchange market. So this is not listed firm, non-listed
Become a partner, limited partner.
partnership. Okay. Yeah. Offer partnership. Okay. Then you buy their shares, right?
Become shareholder.
Become shareholders. Then what can you offer? What can you do with your money? You have a lot of money to invest. Partnership, and then
Does it have to go to companies?
to companies.
Like to a firm? Do you have to
No, you can go to one to X firms to put your money one by one. In each of firms, it's okay. No, no, doesn't have to be one company. What are you going to do? Now, before you offer partnership, what do you do?
research?
Research, right? You do research. Yeah. What kind of research are you doing? What kind of research do you do? You analyze the financial statement, right? Yeah. So assume all of this company do not have financial statement. What are you going to do? No financial statement. But you know that this kind of firms are going to grow very rapidly in the next 3 or 5 years. How? How?
Contract.
Based on what? Based on what? You make an agreement, you offer partnership, based on what? No financial statement. What are you going to do? What are you going to do?
Trust.
Yeah.
Trust.
Trust. Yeah. Yeah, this is practically you search more information, right? Search more info. Just make sure that this firm is really solid and valid. Now, without financial statement, you have to come to the firm and then talk to the owners, yeah, have a look at the operations, and then make yourself kind of a financial statement for yourself. You have to have a look at the cash flow statement. You build your own cash flow statement and yeah, balance sheet statement, and of course income statement. Right. So this is what you have to do without banks. You have to do it by yourself. So if there are 100 companies in Surabaya, and you think that those 100 companies are really worth to invest in, then you have to come one by one to make sure that your money will grow in 3 or 5 years from now, right? This is what we call search cost, right? Search cost. And then now you make a decision. You decide to invest to one company or two or more company. Then after that, what are you going to do without banks? You invest your money in, and then what do you plan to do?
You need to always like check on them.
Sorry?
Like you need to check on them.
Yeah, check on them regularly, right? This is what we call monitoring cost, right? Monitoring cost. So if once you invest your money, you have to monitor the firms, monitor the company, yeah, and then checking up on them about how the business operates. Is it well? Is it not so good? Yeah. Is it not as expected before? You have to make sure of that. So this is the thing that you have to do without financial institutions or especially big banks. Right? Now, if you have banks, so this is I'm going to say this is equity based, right? Yeah, the partnership. Right? Now assume the system finally is banks. Right? Right? What you do now, you put your money in the banks, right? The bank accumulates your money as savings or time deposit or deposit on call. Yeah? And then banks do the search to make sure that your money invested in very good firm, right? By giving loan to this firms. Okay. Now you don't have to do monitoring costs. Why? Because bank do already do the monitoring costs. We call this delegated monitoring. Okay. So you delegate your monitoring roles to the banks, and bank do the monitoring to check the firm performance for you. Okay, that's the function of financial institution in financial system. Okay, and then after that, banks will take profit or what we call net interest margin. Right? The interest charged by banks from the firms, yeah, less the interest sent to you. Right? We got interest from the bank, yeah, the spread from interest from the business side. Right? So this is charged interest, right? And then we can get incoming interest, right? Right? Net interest margin. Net interest margin. So in our morning session, we are talking about gross profit margin and then net profit margin. In bank, we are talking about net interest margin. What is the net interest margin of a bank? The higher the net interest margin, the more profitable the bank is. So this is how bank operates.
So where did they get the interest from? The firm?
Yes, from the firm. So the bank provide loans from the firms, and then firms pay back the loan regularly, right? Yeah. So bank offers uh, debt based, right? Debt based contract, yeah, not equity based contract. So debt based. Okay. It's getting tougher. I know. I still remember equity based and debt based contract. Right? Last week, you buy stock, it's equity based, right? You buy bonds, then that is debt based. Okay.
So what was the net interest margin again?
Net interest margin is spread interest from loan, yeah, and the interest for saving deposit, right? So now say currently for I think the interest rates now is 12% for loan. And then I'm not so sure. Do you check your interest rates on your savings?
For if it was
Yeah.
4.7.
Yeah, give it 5, right? So the spread is 12% minus 5%, right? 7% for the bank. Okay.
Dia duduk pada sini. Buffon.
So do you have any questions about this? You understand? You have any comments? All clear?
Yeah.
Good. Now, my next question is, why bank provide only debt-based contract, not equity-based? Do you have to explain anything? No? Yeah, my next question is, why bank only offers debt-based contract?
There's a high risk if they provide the equity base.
Yeah, it's high risk, costly, right? You have to monitor it almost every day to make sure that the firm you are invested in a good performance, right? That's why bank only offer debt-based contract because from the cost of monitoring cost, this is the cheapest way of investing or financing companies, right? Why? Why? Why debt-based contract is practically or theoretically simplest and less expensive than equity-based?
Because that has interest.
They pay interest, yeah. Why? And then why?
And whatever they do, they must pay it.
Whatever they do, they must pay interest regularly, right? So if bank gives loan to firm, like say for 5 years, and then the firms must pay those interest in 5 years, yeah, regularly. Once the firm fails to pay, even once, yeah, then banks start to check the company, right? It doesn't have to be regularly checking the company. Right? So this is the way they monitor the firm that bank invested in or financing. So that's why debt-based contract is less expensive than equity-based. Right? Right? Do you have any questions on this? Do I have to repeat again which part? Do I have to? Oh, yeah. So in that case, if you if you borrow money from banks, like 3 years, yeah, and then what you have to do to pay back? The first thing that you have to pay is the interest rates, yeah, and then the principal amount along 3 years period between you and bank contract, right? So say in 3 years, in second years you fail to pay interest and principal payment, right? Only once, and then what do you think bank will do? Yeah, come to you, check on you, call on you, yeah, first, and then the second, you cannot pay again, and then yeah, and then they come to you, and debt collector come to your house, and then they talk to you. Yeah, when are you going to pay the debt? Right. So that's the way bank monitor the loan. Yeah, find invested in firms. So very easy. So once the firms cannot pay, then banks start to come into the company. Right. So if equity based, okay, I see that one company has a very good potential in business growth in 3 to 5 years, 3 years from now. Okay, and then you put your money there as a shareholders, and then in the second years, the company has a negative net profit, right? What are you going to do to the company? Yeah, sell the shares, and then what are you going to do to the company?
Nothing.
Yeah,
Nothing.
yeah, nothing. You can do nothing, right? Or as a shareholders, you can come to the company and put yourself there, or you can put, well, friends of yours put there to make monitoring, right? To do the monitoring. Okay, so it's different, right? So you don't really sure when the company perform well or not when you offer equity base. Say in the company that, oh, it's only 3 years, man. I need more time to get net profit, positive net profit. Then what are you going to say? Sell the shares? Okay. Then, okay, I'll wait for another 2 years then, right? You cannot do anything. You're going to issue in the company? No, you cannot do that because it's equity based. But it's debt based, you can sue the company or you can sue your friend that he cannot pay back your loan, right? Okay. Any other question? Get back to my okay. So the second learning goals is to identify the main uses of funds by commercial banks and identify main sources, yeah, for commercial banks. So we touch a bit on this balance sheet of bank. Yeah, this is the easiest way for you to understand. what is the sources of fund of a bank, and then what is the uses of funds by commercial banks. So practically, this is the sources of fund. Yeah, forget about the equity part here, and then this is the uses of fund. And then I'd like you to search, yeah, information on off-balance sheet business. What is that? OBS. OBS. So this is what we call on BS. Right? We can see the financial report of a bank. And then there is a term off balance sheet activities of a bank. What is the off balance sheet activities?
Assets or liabilities not included in the balance sheet.
Yeah, that's why we call it off, right? Off balance sheet.
Foreign
Can
exchange.
you give an example of OBS activities of banks?
Foreign exchange.
In what form? Foreign exchange.
When we transfer our money, and then you have to have the currencies,
Mhm.
like pay through credit card or card.
There, that's off balance sheet. The idea is to do hedging, right? Hedge. Say now your income is in rupiah because you have business in Indonesia, right? And then you have to buy supplies and then buy equipment from Australia. So this IDR yeah, versus Australian dollar, right? Off balance sheet activities. So this is services provided by banks, but banks do not record it on their on balance sheet activities. Right? Okay. So what is the foreign exchange for IDR versus Australian dollar now? 10,000?
10,000.
10,000. So 10,000 IDR per Australian dollar, right? Okay. So what is the risk of this transaction? You have income from Indonesia, and then you have to buy supplies from Australia. What is your risk here?
Fluctuations.
Fluctuation of
So,
this foreign
right.
exchange, right? If say this is 12,000, yeah, you need more rupiah, right, to buy Australian dollar, yeah, instead of now, right? So this way, we need to go to the bank, yeah, and then ask bank to provide us with hedging strategy. So hedging strategy. So this transaction doesn't have to be done today. So say you plan to buy equipment or supplies in 3 months from now, right? And then you have to fix the foreign exchange to like, I don't know, 11,000, yeah? But you fixed it today for 3 months forward. We call that forward transaction, right? So the transaction is basically is not done today, but it has to be on record for bank, right? So bank knows when to execute this kind of transaction. So this kind of transaction that is not done today is practically off balance sheet activities of bank. Yeah. Now, for modern banking system, these transactions valued more highly than this. So larger amount of money is in OBS, yeah, in comparison with the on BS. Now, the latest 5 to 10 years. So there are many transactions uh, from banks, from commercials, from company asking for hedging strategy because there are many international trades now. International trades, like Indonesian company want to do something outside Indonesia, then they have to do transaction with this kind of foreign exchange, right? Australian dollar, Singapore dollar, US dollar, Japanese yen. So many banks now do this kind of service. Okay. Do you have any question on this? Clear? Good. Now, do you know GFC?
Germany fried chicken.
Germany Fried Chicken. GFC versus KFC. GFC is global financial crisis. You know 2008, right? 2008. Yeah. I think yeah we have enough time for you to work in group. Yeah. Just to give like what five points on global financial crisis, and please find what is the role of commercial banks, yeah, in global financial crisis. I think we have 15 minutes. What is the role of commercial banks in global financial crisis? You can work in group, you can work by yourself, up to you. Yes? Oh, no, no. You just share your findings in class. What is the role of commercial banks in global financial crisis? So I'll give you some keywords. Yeah? Subprime mortgage. So this is one keyword. You can search for the role of commercial bank in global financial crisis. One more hint. Subprime mortgage is related to this. One of the bank activities in giving loans to household. Right? Yeah. Subprime mortgage. Have you heard about subprime mortgage?
But that's related to the
Yeah, subprime mortgage is related to these bank activities of giving loan to household. ya, mortgage KPR, kredit pemilikan rumah, atau KPA, pemilikan apartemen. Ya. And then, what is the role of commercial banks in global financial crisis?
Subprime mortgage.
Is subprime mortgage.
Ya. Bisa juga. Hubungannya bisa. Oh, property asset mortgage.
You have anything about subprime mortgage?
Loan offered to people who have low income. Yeah, like for credit.
Mortgage loan, right? Mortgage facilities to low income
Yeah.
also.
With high interest.
High interest.
Yes.
Okay. Then, why bank put high interest on subprime mortgage?
They have bad history.
Sorry?
Bad history.
Bad history, meaning high risk, right?
Yes.
Because of high risk. Okay? Yeah. And then, what is the most possible risk that bank can face because of giving this high interest with
I
high
have a
risk?
topic.
Non-performing loan, right? Yeah. And then it accumulates because the people who got mortgage facility come from low income household, right? So they cannot put aside money to pay the interest and also the principals. Yeah, they keep on borrowing, right? Yeah. So there are very high non-performing loan on commercial banks in the US, right? Yeah, because of this subprime mortgage facilities. So this is the on balance sheet activities. On. So this is on VS. We can see the on VS. The off balance sheet of VS. Yeah. Because this is the high risk loan, bank wants to put aside the risk, to sell the risk outside banks. Yeah. And then this is bank A, yeah, sells subprime mortgage facilities, yeah, to other financial institutions?
But why would they want to buy it?
That's a good question. Yeah. Why do you think?
Sorry.
Do you think any financial institution would buy those kind of mortgage? No, right?
Because of the financial crisis.
Because of the
Financial crisis.
because of the financial crisis. This is before financial crisis. This is in 2006. Yeah, this is in 2005, 2006. So I'm going to put here. This is 2005, right? So what banks did in the U.S. is doing this off balance sheet activities. They sell subprime mortgage to other financial institutions. So why do other financial institutions want to buy them? Right? Because they need them.
They
Right?
also have bad ratings.
Bad ratings. Because the interest is so high. Right?
Oh, interest is so high.
Yeah. The U.S. interest rate is quite low. It's 3%, and then the subprime mortgage could offer 8 to 10%.
Wow.
Right? Again, why financial institution want to buy them? This is practically junk, right? So, yeah, this is junk. How do you sell such product to large financial institutions across the world? There are so many movies about this. You can watch the movies and then learn from them, right? So there are prime mortgage, yeah, and subprime mortgage. Prime mortgage, if bank sells this prime mortgage, yeah, and then the financial institution sell this as bonds.
Well, how do you mean like banks sell the mortgage?
Yeah, so like this. So if you have portfolio of housing mortgage,
Yeah.
yeah, the bank need more liquidity, right, to give loan to household or to the commercials or to the companies.
Yeah.
And because of the restricted amount of this savings, time deposit, and deposit on calls. So what they are trying to do is they sell all of this portfolio.
Or
Yeah,
they sell the portfolio to other companies.
yes, they
So the
sell.
other companies is the one who take the burden.
Yes. And then in return, bank got more cash. This, right? They sell the asset and then they get more cash, and then they have this more sources of funds. And then they put again those sources of fund to generate another mortgage, right? And then sell it again like that. 2005, 2006. And starting in 2006, most of the portfolio of bank in the US is this part, subprime mortgage, right? And then the financial institution who bought this portfolio, they issued bonds, right, based on this subprime mortgage. And you can imagine the bonds based on junk, rubbish, right? The way to sell it, to mix this subprime mortgage with prime mortgage product. So if I say this is non-investment grade, yeah, it means if you want to invest in this, the default rate is very high, but in return you get high interest rates, right? So the financial markets or the financial institution mix this non-investment grade with investment grade, right? Yeah. So say the rating of the subprime mortgage is D. D is the worst, right? And then mixed with this triple A. Triple A is the first tier, the best investment grade. And then they mix this, become double A or triple B or double B. Means after mix this subprime with prime mortgage, it becomes investment grade. for some financial institution who has the risk appetite similar with double A up to double B. Okay? Then the story begins. Right? This is subprime mortgage. You know that this is practically non-investment grade, and then you know that this is high risk, and the default risk is very high. Now, starting in 2007, there are so many subprime mortgage default. Okay, when subprime mortgage default, then the interest payment is also
Stop.
stopped, right? So it's stopped. There is no value in this subprime mortgage, and also there is lower value in this securities investment grade, right? And then people who had this portfolio start to
So
sell and have a very bad return on this. Okay. And then banks, what happened to banks? The commercial banks? The default rate is very high. Okay. And then the default rate is very high. And every closing day, bank has to balance their asset and liabilities. Right? In order to do that, banks has what we call money market. You know this? Pasar uang, very short term. You can borrow it like 2 or 3 hours or 8 hours. Okay? So banks in the US start to go to money market, yeah, to make this their asset and liabilities balance. Not only one bank, almost every bank in the US. So the money market has shortage of liquidity.
So the money market is provided by the bank.
By the bank, by the central banks, yeah,
And all the
mostly
other
by the central
commercial
bank.
banks like
Yes.
borrowed money
Yeah.
from the central bank.
Yeah. So if all of us has banks, yeah, and then I can borrow money from your banks, you can borrow from each other, just to make our asset and liability balance in one day. So in closing, you have to balance, right? One way to make this balance is to borrow money from very short-term market. We call that money market. Yeah, and then there is a shortage of liquidity of money market in the US. So bank cannot balance their asset and liabilities on Friday night, September 2008, right? And then the first person uh, to call by US government, I think you know this person, Warren Buffett. Warren Buffett, yeah, he refused to bail out the financial system, the US financial system in that day, Friday night, right? You know, Lehman Brothers, Bear Stearns start to fall down at that time. That is because of this housing mortgage from the commercial banks, right? And that is because of the off-balance sheet activities of commercial banks, right? By selling their subprime mortgage to other financial institutions, repackage it uh, in order to get investment grade, yeah, and then one stop the payment from subprime mortgage customer, then the value of this investment grade almost zero, right? So that's the short story of global financial crisis in 2008.
Wait a minute. So like this subprime mortgage, they sell like house mortgage,
Yeah,
and the low income family won't buy these houses.
yeah,
Um,
because the bank provide very easily. Yeah.
But with high interest.
with high interest. Yeah.
So, why did the like low-income people stop this kind of mortgage? Is it because the houses like price went down and they don't need those properties
I think
anymore?
this is, I can give a short description. Low income family is for US household to get social security support, right? I think for the bi-weekly, they got like 600 to 800 US dollar. So in a month, 1,600, right?
Well,
Maximum.
that's quite a lot.
That's quite a lot. Yeah, you're right. But once the bank provide with mortgage, they have houses. What do you think they buy? Furnitures, right? Furnitures. So they spend 80% of their monthly payment from the US government to buy furnitures instead of put it aside to pay the interest rate of their mortgage. Right? That's interesting story.
Wow.
Yeah, that's true.
So basically, it's the financial crisis just because all those people don't pay the mortgage.
Yeah,
Oh,
as easy as that,
wow.
right?
Wow.
And because bank keep taking more risk, yeah, because they really want to
I mean,
have
wait, but why
higher
don't
net
the
interest.
bank sells the house? I mean, even though
Yeah, that would be a possible way to do by the bank, but almost all of bank uh, have those kind of portfolio, so they have these assets, so they have to sell the houses, right? But the prices is not really good in that time, right? So if they get like houses 30,000 US dollar, bank can only sell it for 500 US dollar in that time. So almost no value of those fixed assets. So the market is really stuck because of financial institution. We call it commercial banks.
But now bukannya harga like price like the house's price went up a lot.
Yeah,
Is it because
now,
the bank now don't like offer any services for house market?
yeah, they offer for prime mortgage only now. So come back to their real business. Okay. So I'm going to go back after 10 minutes break in Basel regulation. So this is related to application of Basel regulation and central bank rules. Okay. Let's have a